Markets keep on breaking records and the Dow is fast approaching the 20,000 points mark. That's something that would never have been anticipated a year or two ago. But how sustainable is this?
Yeah, I think breaking records is always great. It keeps people on their toes and it keeps the market exciting. Interesting point to point out is it broke 10,000 for the first time in March 1999. So it's taken the market roughly, was it 18 years to now double. It just shows you that markets don't always go up. Going forward though, I reckon we break the 20,000 mark, if not today, by the end of the week. And then going forward, it all comes down to how much the market believes their own hype. How much do they believe that Donald Trump spends a lot, cuts tax rates? And as long as the market believes its own hype, I think the market keeps going higher. And then when Trump's inaugurated as president in January next year, and we start to see his policies in the first 100 days come to fruition, I think then the market has a reality check and says, what was our expectations, what was delivered, and how have they differed? And if it's differed on the downside, you see the market drop, and if it's differed on the upside, you see the market continuing to go higher.
It almost seems like a foregone conclusion that the US will raise rates tonight. But I suppose markets will be listening closely to hear whether they plan, that is the US Fed plans to accelerate rate hikes next year.
Yeah, so if you look at the interest rate markets, they're pricing in 100% chance of an interest rate hike today, which means that if there isn't an interest rate hike, you're going to see a lot of stocks, particularly banks, come under a huge amount of pressure. But like I said, it does look like a foregone conclusion that interest rates are going to go higher. Like you're saying, the big thing that people are going to be looking at is what are the hints for further rate hikes next year. If we rewind to last year, this time when they raised rates for the first time, the expectation for 2016 was there were going to be at least 4 rate hikes. We're now in a situation where there's only going to be 1 rate hike. So even it doesn't matter what Janet Yellen says in the news conference after the rates decision, we still need to see what fundamentals come through. There's a lot of unknowns with Donald Trump coming in. How much does he spend? How much does that lead to inflation? And how does the Fed have to respond to that? So still a lot of unknowns, and I think that brings a bit of caution to the market.
Yes, let's stay with Mr. Trump, who appears to be getting the Chinese backs up. He's talking about recognizing potentially Taiwan on its own rather than looking at it as part of China, because that is what China tends to prefer. And this is being viewed as quite reckless and negative on his part. Do you anticipate that we're going to have a lot of geopolitical problems, particularly when he assumes office? And what sort of impact is that going to have on global markets?
Yeah, I think he's got a brash style of politics, and if depending on how other countries view that, it can create tensions. Global trade is good for everyone. The US and China, them trading together is good for both parties. So I don't see the US upsetting China too much, and I don't see China upsetting the US too much. They need each other a lot just for their general well-being and general wealth creation going forward. I don't think Donald Trump's a stupid man. I think he knows what he's doing. He's probably got a plan in the back of his mind. But if things do go south, then global growth does get hurt. So holding thumbs that everything is smoothed over and relations between the two countries get better instead of worse. And that trade improves between them. If there is trade, then Chinese get to make things and export it to the US, which creates wealth for them. And on the US, they get to buy things cheaper than they would be able to manufacture it at home. And that also creates wealth in the US.
Well, let's hope so. Here at home, we see that consumer the consumer price index, rose by 6.6% for November. That's on an annual basis. It's steadily ticking up. You know, it was about 5.9% in August, and it went to 6.1%, 6.4%. Now we're at 6.6%. When we see that the US is likely to raise rates, is the Reserve Bank also going to be forced to do the same? And what does it ultimately mean for markets and the economy?
Yeah, so today's inflation reading was exactly in line with what the Reserve Bank had forecast for this quarter. this quarter's inflation. So it's not out of line with what they're expecting, and that's a good thing going forward. It means that the expectations that inflation will probably come within the band next year is still on track. Like you're saying, with the US increasing interest rates, that might lead to a weaker currency. Weaker currency means we import inflation. Coupled with that, we've got a weaker oil price. Oil price currently at about $55 a barrel. The Reserve Bank was forecasting $53.50 a barrel for 2017, so we're slightly higher than that. With a weaker exchange rate coming through, then maybe we import inflation and we stay above that band, and then the Reserve Bank's got nothing to do but raise rates. Their hands will be tied. So we'll have to wait and see what happens. Let's see what the currency does when the US does raise rates. You would think that the currency's already factored in the fact that the US is raising rates today and probably 1 or 2 times in the next 6 months. And if that is factored in, I don't see too much a problem. If it isn't factored in and the rand weakens, then maybe we import extra inflation and the Reserve Bank has to follow what the US is doing in terms of monetary policy direction.
Well, Michael, a few years ago, if you were investing in equities, you'd be getting double-digit returns, and it was quite a favorable place to invest. But that's not the case now. You're lucky if you get sort of a 5% return. So given that fact, what sort of asset classes are you investing in for your clients so that they can get a good return on their investment?
Yeah, I think it's when you draw the line where your returns come through. I mean, the last couple of years, the market's been very flat, nowhere close to double-digit returns that we had seen post-2008. This year, if you look at the top 40, it's actually down about 4% for the year, so you'd be going backwards. But it comes down to a mindset change. If you're investing for the long run, and I'm talking 10, 15 years, lower prices is a good thing. If you're only investing for a couple of days or a couple of months, then obviously low prices isn't good. But for someone who's still in their youth, like me and you, Numpu, lower prices is a good thing. It means that we get to buy more assets with the same amount of money, and when retirement comes around, we get the dividend flows from those assets. So for our client base, we all equity. We've conditioned them to know that markets don't only go up, markets go down as well. And the volatility in stock prices is the reason that over the long run, stock prices perform better than most other asset classes. If it was easy, everyone would be doing it, and the returns wouldn't be there over the long run. So head down and keep buying equities on a monthly basis if you can. All
right. Well, thank you very much for your insights there, Michael. That was Michael Treherne. He's a portfolio manager at Vestact. After the break, more business news for you.